Hello, and welcome to On Air with Akin Gump. I'm your host, Jose Garriga. We have a special episode for you today in our series on environmental, social, and corporate governance, or ESG, as it features a webinar presented recently by two of the heads of Akin Gump's ESG group, Washington, D.C.-based partner Stacey Mitchell and London partner Amy Kennedy, along with London financial regulatory partner Ezra Zahabi. The topic is ESG transparency, and the agenda ranges broadly, crisscrossing the Atlantic to look at EU plans on ESG and sustainable finance, an overview of U.S. climate and ESG developments, EU sustainable finance transparency requirements, the UK Sustainable Finance Initiative, and much more. Welcome to the podcast. Over to you, Amy.
Welcome, everyone. Our participant numbers seem to be slowing down, so we will start. Welcome to the latest in our Akin ESG series, focusing on the emergence of ESG transparency through the UK and Europe and into the US. I'm Amy Kennedy, a partner in our London office and one of the co-chairs of our ESG practice, and I'm pleased to be joined today by my fellow partners and co-chair Stacey Mitchell, based in DC, and London partner Ezra Zahabi. In terms of our agenda for today, we want to consider in more detail topical ESG issues, particularly drawing on experience across the UK and Europe, and particularly under the Biden administration most recently. We may see sort of changing trends throughout the US that have come across from Europe and the UK. We're going to consider developments more generally and focus on the current initiatives, frameworks, and regulations both here and in the US. In terms of housekeeping, I'm advised that CLE credit is available for the hour. If you would like to receive credit for today's presentation, then details were included within the confirmation email, and I believe that an attorney affirmation form is required to be provided to Natasha Hill, and we will send the code later on in the presentation. We'll aim to leave a few minutes at the end for Q&A, but of course, if there's anything that comes up as you progress, please do use the Q&A function on the Zoom bar, and we'll try to address that going forwards. So moving forwards, next slide, and to get us underway, Ezra, could you talk about, to kick us off, the European plans for ESG and sustainable finance to set the scene?
Absolutely. Thank you, Amy. Can I have the next slide, please? Thank you. So you can see from the sustainability tree here, this sort of illustrates the EU's very public prioritization of its commitment to achieve the objectives of the Paris Agreement. And, you know, in order to actually achieve those objectives, there has been a plethora of different initiatives, strategies, plans across various industry sectors, from varying from transport to energy production, to chemicals, agriculture. So all kinds of things going on in Europe at the moment. And so what we will be talking about today is very much framed across this broader initiative that's really that really signifies a kind of paradigm shift in the EU in transforming the EU economic structure to a kind of a climate neutral circular economy by 2050. Could I have the next slide, please? The set of these policies, very broad ranging, as I noted, are housed within the European Green Deal, which is really this set of initiatives and policies and everything that goes with those that the EU is currently creating and putting forward. And as a kind of an essential element of that, clearly, you know, there's the sort of the sustainable finance dimension, which is something that we'll focus on today. But just to note, you know, I'll just take a second to note really the spectrum of the initiatives and its incredibly broad range. And we think, given the broad range, it's really the next almost 30 years, I think, will signal amazing challenges and very interesting times for all, but also real opportunity, I think, for most of our client base. Next slide, please. And you'll see here that the European Green Deal, the EU has earmarked approximately €1 trillion that will be engaged in actually achieving these objectives, putting forward, you know, plans from whether it's actual investment, guarantees, subsidies in achieving sectoral transformation, subsidies for making sure that specific areas and geographies are not left behind. So really a lot going on in the financial sector also in the context of the ESG and sustainability developments in the EU. The next slide, please.
Thanks, Ezra. It's certainly ambitious plans there coming from the European side. So how do we actually see those plans being implemented?
So here, the European climate law. And so there's a couple of examples. I mean, there clearly will be like looking at the broad spectrum of this whole big paradigmatic change in the EU. There will be a huge number of specific legislative acts promulgated. But I think a couple of very good examples of what's going on are, the first one is the European climate law. So still in proposal stage, but it really translates the political commitment to a binding legal obligation. So the political commitment being that the way that the EU will operate will ensure that it does its part in holding the increase in global warming to below 2% above pre-industrial levels. And the European climate law is really a framework regulation. And so what it will do is that it will facilitate the creation and promulgation of future laws, both domestically within the EU member states, as well as further EU level laws, secondary legislation, guidelines, directives, other measures across multiple different areas. And so it's likely that this is the framework law that will give rise to, for example, laws around creating tax incentive schemes, laws around prohibiting the use of certain types of chemicals or restricting the production of certain types of consumables, that don't utilize resources efficiently, for example. So it's a framework law. It's really intended to hardwire the political commitments in then the more detailed legal framework of the European Union. Could I have the next slide, please? And another example then of how the European Green Deal is going to be implemented in practice is another proposal stage piece of legislation. So this is a proposal for a new EU directive on corporate due diligence and accountability. And interestingly here, so this proposal introduces a binding obligation on corporations to have in place proper due diligence processes for their own operations, but also across their supply chains, to ensure that their operations are consistent with the sort of standards and requirements across corporate governance, human rights, environmental standards, and so forth. This requirement to introduce proper due diligence is then weighted against a civil liability regime, which allows a remedy or creates a remedy for example, environmental pollution. So individuals or companies or governments potentially who have been adversely affected by corporations who have not performed their due diligence properly, have otherwise breached their obligations under this new directive on corporate accountability. Those affected parties will have an avenue to seek a remedy against those corporations. So something to certainly focus minds. And interestingly, there's a proposed extraterritorial application to this as well. So non-EU entities that sell goods or provide services in the EU would be caught by this proposal, as well as EU entities.
Thanks, Ezra. One question that we've received from the audience there, I think you mentioned sort of pre-industrial levels in your description. Is that something which is clearly defined or easily explainable?
So there is, I think that I don't know exactly what that is, but there is, I think that it might be, but they might be using that sort of carbon dating methodology, but there is a specific global temperature, and that has been defined. I don't have it to hand, but it is a defined concept.
Understood. That's helpful. Thank you. And I think generally, Ezra, very clear there in terms of European approach and clearly where we're heading out in Europe. I suppose, Stacey, as the slides dictate, could you sort of just illustrate how this compares to the US?
Absolutely, and thank you, Amy. So the US, I think, is what we can fairly call in catch-up mode, but looks to be doing it in rather swift pace. Shortly after his inauguration, President Biden rolled out a series of executive orders, and January 27th was dubbed Climate Day in the US, in conjunction with a series of directives that he issued to agencies, calling on them to address climate change. He made clear that it would be a whole of government approach, perhaps not to be outdone by the EU. He has sort of proposed broadly legislative and administrative agendas to the tune of $2 trillion US dollars. And the Biden-Harris administration has set out their broad policy goals, which include a carbon pollution-free energy by 2035, and net zero emissions in the US by 2050. What's important, of course, to keep in mind when considering what's happening in the US is that as aggressive as the administration's policies might be, the Democrats, although they do control both houses of Congress, it is by truly the thinnest of margins. In fact, our Vice President Harris actually has to break ties in the Senate because it is divided evenly 50-50. And in our House of Representatives, there is a very, very thin margin of 11 seats. So what that really tells us is that from the perspective of any sort of anticipated legislative action, particularly on climate or environmental social governance, it will be, I think, difficult to attain, and absent the use of the filibuster or budget reconciliation, there is going to have to be a substantial amount of bipartisanship in order to reach any legislative steps. However, turning to the next slide, our separate branches of government does allow the president quite a broad swath of authorities. As I think most on this call are aware, on his inauguration day, President Biden rejoined the Paris Climate Agreement. He has, as I said, prioritized climate across all of our branches, administrative branches. He has put together recently this $2 trillion infrastructure plan, and then plans to hold next week a climate summit on April 22nd. What will be announced during that climate summit is unclear, but we can certainly anticipate seeing the United States nationally determined contribution, which will, cascade down into what we can see as incoming legislation. Next slide.
Thanks, Stacey. It's interesting, obviously, to see those initial comparisons, and also from the European perspective, the sort of influence of the changed administration. And if we're looking ahead as to what might be the case for the US, looking again back to you, Ezra, how is this going to get how do the European guidelines and rules, how are we getting those implemented in practice in terms of those sustainable finance regimes and the various frameworks?
Right. And so this is really the EU's sustainable finance initiative. And so it's sort of a part of the European Green Deal, really supports those policy objectives. And it's an attempt by the European Union to use a kind of a transparency focus on trying to guide private investment and private flows of capital to where they need to go in order for the European Union to achieve its commitments. And so there are sort of three primary areas as I see them. So there's, on the one hand, there's a sort of a standardized framework or a classification system to define what is actually green or environmentally sustainable. And that's set out on the taxonomy regulation. There's a sort of disclosure, so enhanced transparency, which is really a sort of focal point at this point, certainly at this stage. So we're not yet at a stage where there's a sort of a mandatory requirement in any way to make sustainable investments. But what there will be increasingly is the kind of soft pressure that's created by requiring sort of financial institutions to, and also listed companies and large corporations, to make their approach to sustainability and potentially their performance around ESG or sustainability publicly available. And so the sustainability disclosure focus is about producing compelling market participants and financial institutions to produce this information on a regular basis, make it standardized so that it's comparable, it's consistent, and it's easy to see who's doing what. The idea being that there will be pressure from the sort of the investor and consumer end to ensure that the financial institutions are doing, quote unquote, the right thing. There's whether or not that will ultimately be the case will remain to be seen. But certainly that's sort of the impetus behind enhancing disclosure. And then there's sort of a set of climate benchmarks, which is a very, very kind of central idea, I think, to the institutionalized standardized management of money in the EU, which is that, sort of interacts with some of the other EU initiatives and preferences around the institutional asset management. And the idea that for consumers, it's a sort of a favored outcome to have non-actively managed funds that follow various benchmarks, and introducing climate benchmarks in that set is a sort of another key development. And then otherwise there are other EU standards and labels around sustainability that are being developed, such as the EU Green Bond Standard, Eco Label for retail investment. There are sort of supporting amendments across the AIFMD, MiFID II, and the UCITS Directive, which are the framework legislations governing the investment management industry in the EU. And there'll be requirements there to, number one, take into consideration the investors' preferences around ESG, and also to incorporate ESG and specifically climate-related considerations into the risk management framework for the investment managers. And then finally, there's a focus on sort of enhanced transparency in corporate reporting, and so new guidelines and expectations for companies to report climate-related information. Next slide, please. So the three, I spoke a little bit about the three principal legislative initiatives here. So the first one here, the Sustainable Finance Disclosure Regulation, I expect that many on this call will be painfully and intimately familiar with this, because this took effect earlier this year in March. And so it broadly requires the public disclosure of investment managers as well as other financial institutions of how, number one, how they integrate sustainability risk, and number two, their ESG performance. And as mentioned, really with a view to improving transparency and comparability of the sustainability information and performance of financial institutions across the market. The taxonomy regulation, which currently sort of sets out a green framework. There will be other taxonomies in due course. And then the non-financial reporting directive, which is the piece of legislation that governs non-financial disclosure requirements of large listed companies in the EU. Next slide, please. So the Sustainable Finance Disclosure Regulation, I won't dwell on it. I think there's been a few occasions already. I'm sure that most people have sort of working knowledge of this. But just to recap, it introduces disclosure requirements both at the level of the financial institution as well as at the level of the various products being provided or promoted by the financial institution. And interestingly, I think some of the kind of discussions have been around additional disclosure requirements for light green and dark green products. as well as the kind of the very detailed requirements that are set out in the secondary legislation around the disclosure, particularly of the ESG performance. And here, just to recap, sustainability risk here in the context of the SFDR and the taxonomy regulation is a defined concept that very broadly is any event or condition that, were it to occur, could cause a potential material negative impact on the value of the investment. So broad-ranging concept. Could we skip the next two slides, please, and go to... Thank you. So the non-financial reporting directive. So currently, this, as mentioned, this applies to large listed entities in the EU, as well as certain other types of entities like banks, insurance companies, and any other entity that's designated as a public interest entity in the EU. So currently, there are also already disclosure requirements around the sort of the approach and performance of the entities affected around their environmental protection and their internal policies and performance around it, so social responsibility, anti-corruption, bribery, human rights, that kind of thing. Next slide, please. And there are a few proposals underway. So firstly, there's a proposal to extend the scope. And so the idea is that you either, there's various proposals how that might be extended. Really, it will cover a broader range of entities. It might cover entities that are smaller in scope, simply cover all public interest entities, potentially, just covering small entities also. So it will, there'll be a greater number of entities that will be subject to these requirements. In addition, the additional disclosure requirements that will be imposed will include a requirement for the non-financial statements to explain how and to what extent the activities of the corporation are, quote unquote, associated with environmentally sustainable economic activities. So, and that translates into having to report how the proportion of turnover that's derived from environmentally sustainable activities, and the proportion of capex and opex that are related to assets or processes that are associated with environmentally sustainable activities. And I guess that this feeds into the directing the financial flow. So the idea is that once you make the information available, and the investor pressure and the general momentum around this already is present, the investors will be able to exert pressure on their asset managers, for example, or just make their choices themselves, and will guide their investment to those companies that perform better from a sustainability point of view compared to their peers, that may be sort of worse performers. There's some talk of adding also specific data around environmental performance that'll be more quantitative rather than these sort of qualitative descriptions. Next slide, please. And so a key sort of framework here is the taxonomy regulation. And so the taxonomy regulation seeks to really standardize environmentally sustainable investment. The EU engaged a sort of a technical experts group that pretty much came up with the taxonomy regulation, and it is a dense piece of legislation. And there's a lot of quantitative data involved in actually assessing what is environmentally sustainable. But very broadly, under the taxonomy regulation, an economic activity is deemed to be environmentally sustainable if it meets the 4 objectives set out in the slide. So if it substantially contributes to one or more of specified environmental objectives, if it does no significant harm to any of those objectives, it complies. So the activities are undertaken in a manner that is compliant with certain minimum safeguards, so international standards really. And in addition, it complies with certain other technical screening criteria, so fairly granular, data-heavy information. Next slide, please. And so the environmental objectives they will become effective in a sort of phased manner And there'll be the climate change mitigation, climate change adaptation are the ones from next January, and that will be the sort of the first wave of focus within the European Union, also within the taxonomy regulation. The concept of no significant harm. So the activity, for it to be environmentally sustainable, it has to contribute sustainably, substantially to one of these objectives. And then in addition to that, it must not harm significantly any of the others. And so it's this sort of happy marriage between doing something that's good and also not doing something that is clearly damaging to any of the others. Minimum safeguards, as I mentioned, these basic standards around United Nations guiding principles on business and human rights, for example, or the OECD guidelines for multinational enterprises, International Bill of Human Rights, fairly high level standards, easy for most operating companies to comply in a sort of variety of different ways. So there's not a single way of complying, but they introduce a minimum standard. And then these technical screening criteria that are more data heavy and quantitative. Next slide, please.
Thanks, Ezra. Before we touch on sort of some of the UK elements, just to respond to one of the questions we've had through, to what sort of extent does the disclosure content that you've described require the use of metrics and development of sort of internal reporting systems for those metrics? I suppose the point here being that just because it's non-financial reporting doesn't mean the absence of measurements. And I suppose that's touching on the likes of SASB and PRI and related guidance. Is that right?
Yeah. And I guess that it probably, so I guess that there's a few things to think about. So, whether it's the reporting of like for corporations or the reporting for financial institutions, it is likely that they will, like all of these reports are going to have some kind of data underpinning the actual reports that are being made. The SFDR clearly has, in terms of the reporting around the ESG performance, there's some pretty data heavy requirements there in the principal adverse impacts report. So those are very they're very quantitative. So there's a need to obtain quantitative data and express the reports in that manner. For the others, I think that it is likely that there's going to be sort of in various conventions around reporting particular information, but all of it I think is going to have to be documented. So in reality, I think that the sort of the increased transparency across the spectrum is going to be based on data, and certainly the sort of the proposals around the non-financial information reporting is also premised on the idea that there will be probably at least TCFD aligned disclosure. So there will be data that will need to be produced in accordance with with sort of external standards. So I think that the idea of really behind these initiatives is that the data would be produced in a manner that's really consistent, so that it can be assessed, in an actually comparable manner, which is a problem at the moment. So I think that everybody will need to figure out how they actually get the data. Over time, I suspect that there will be more sort of external provision of the data and more, available ratings and like that. But at the initial stages, you'll have to figure out how to actually obtain, sort of quantitative data as well as qualitative.
No, I understood. That's helpful. And I guess from that, then you end up determining materiality and what that means. And that's obviously a whole other discussion for another day. But no, thank you for that. And I think that probably leads us on to quite neatly on to the UK. And obviously we've touched on Europe, but on the basis that Brexit has happened and we've had the withdrawal from the EU. Can you just touch a little bit on the UK nuances as well? Because I think that's interesting colour for the US.
Sure. So the UK, so if we look back at the SFDR, for example, which is really focused on E, S, and G. Now, clearly, there's a political emphasis on climate change and environmental sustainability. But really, the EU framework around the disclosure for financial institutions, it contemplates all three. The UK took a slightly different path, and it has clearly prioritised climate-related financial disclosures. And so the UK is looking to establish a TCFD aligned disclosure regime that will be applied across different types of institutions, so financial institutions, pension schemes, listed entities, large private corporate entities, and they will. But all of these will be focused on the climate-related disclosures. And so, what does this actually mean in practice? Well, the four principal areas of disclosure will include governance, strategy, risk management, and then the underlying metrics and targets. So the governance element, part of this is really to make sure that sort of climate disclosure and environmental performance are considerations that are taken and incorporated into business strategies at the highest level. So it's a board level responsibility, and the expectation is that the boards will be actively engaged in this. And so the disclosures will include, for example, what's the board's oversight of climate related risks and opportunities. And so it's very much looking at, how is the business integrating the sort of the understanding of climate change and how that will affect the business in their practice, in their sort of strategic practices going forward, as well as thinking about like how that is then integrated into the operational management further down in the operation of the business. Then in strategy, again, it's really financial planning, for example, like things like opportunities over the short, medium, long term, impact of climate-related risks around geographies potentially down the supply chain, interplay of things like political risk in areas where your suppliers might be based, that's derived from climate risk, for example. And then really sort of stress testing the business. And so seeing how would it perform in different types of scenarios. So, if the climate was to warm, globally by 1%, 0.5%, 2%, what would that actually mean for the business? And then risk management. There's been a huge emphasis in the UK by the Bank of England, by the UK financial regulators, pension regulators, on ensuring that the UK financial institutions are actively thinking about risk that is created by climate change and how that will affect their business. And so they will, the disclosure really around that is to be clear on how risk management addresses climate change, how that's integrated into the overall kind of risk identification, assessment, mitigation processes. And I suppose that in there again, all of these disclosures to some extent they're interrelated in that the sort of the strategy. It may be that as part of the risk management, there's a strategic vision for the business over the next 30 years to see how it transforms from one kind of a business to another kind of a business. And then, a sort of an emphasis on providing this kind of quantitative data, again, around performance. So in particular on greenhouse gas emissions and risks related to the same. Next slide, please. And so this is just a snapshot of the different types of entities and the time over which these requirements are expected to become effective. And so these requirements will be phased in over the next 4 years or so. But it is expected that there will be TCFD aligned disclosure across really largely most of the UK economy by the end of 2025. Next slide, please. And just to sort of recap, so in the UK currently there's a companies with UK premium listing are required to confirm TCFD-aligned disclosure, and to the extent that they are unable to make such disclosure, explain why that might be. And so these requirements have been applicable to accounting periods from January 2021. So, expecting first annual reports to be published next year. So the UK intention is to make sure that these TCFD-aligned disclosures would be mandatory by 2025. I think that there's some uncertainty as to whether that really means wholesale disclosure. If it means best efforts disclosure, I think there's still going to be some comply or explain feasibility there. But increasingly, I think that the changes in the legal framework combined with the changes around investor expectation and the attitudes towards disclosure of at the very least sort of policies and risk management arrangements will mean that most of the UK sort of financial institutions and larger corporations will be private or public, will be making this information available consistently after 2025. And worth noting that the UK will establish its own taxonomy. Effectively, it will be based on the sort of the scientific work that was undertaken by the EU technical experts group, and so they will use effectively the same type of methodology. But we'll see, whether there'll be some more flexibility within that framework, or whether ultimately it will be substantially the same. Next slide, please.
Thanks, Ezra. Just before we touch on the US again with Stacey and the impact from the Biden administration, you mentioned earlier that the corporate ESG accountability is possible extraterritorial application. Is that something that's featured in any of the other regulations at the moment, or something that's sort of on the agenda?
Yeah, so currently, under the SFDR, there's an open question as to how those disclosure requirements would apply to non-EU financial institutions, certainly to the extent that they are being marketed in the EU. Under the taxonomy regulation also, so there's EU guidance out there in the context of the taxonomy regulation on the application of the disclosure requirements. That suggests that, to the extent that the products are being marketed in the EU, the disclosure requirements would apply. But in fact, the application is sufficiently uncertain that there's an open request to the European Commission by the European regulatory authorities asking for the European Commission to please clarify some fairly fundamental terms of the SFDR, including this extraterritorial application. For the UK, it's likely that the premium listed requirement, for example, and that's just going to apply to any company that has a listing in the EU, so regardless of the jurisdiction. Otherwise, it's fairly specific to the UK entities. I think that in the EU, there is increasingly a question as to how wide the application of the EU laws really stretches. And so, there's various touch points, obviously. So there's a question: do the disclosure requirements apply? Do you have to, if you're making, if you're sort of making statements about sustainable investment, do they actually then just need to be sustainable investment within the meaning of the taxonomy regulation? At where there's any kind of a touch point with the EU investors, if you just have EU investors in the fund, if you have a sort of even an older sort of historic managed account relationship, for example, or if you've got subsidiaries in the EU, to what extent can you be, can you apply one set of standards in the EU and another set somewhere else? So there's a lot of there's kind of a lack of clarity. I think that there's a question around what's going to happen elsewhere in the world and how justified would the EU feel in imposing these standards internationally as a kind of gateway requirement to the EU.
I know, understood, and I sort of have in my mind it's always about sort of AML and sanctions and how those sorts of legislations and regulations changed across international perspective, and it seems we're in a slightly similar situation here with ESG. So Stacey, with that backdrop, could we ask you to sort of touch on the US climate and ESG initiatives, and particularly since the Biden administration?
Absolutely. Again, while the U.S. is currently lagging both the UK and the EU on prescriptive regulations, we do have some things that need to be considered. In 2010, actually, over a decade ago, the agency issued an interpretive release clarifying how then existing, and certainly currently still existing SEC rules could actually require public companies to be required to describe climate change matters. It relied on and continues to rely on its existing materiality standard, which is whether there's a substantial likelihood that a reasonable investor would consider it important in deciding on how to vote or to make an investment decision. And as the slide depicts here, there are 4 topics that may trigger disclosure. That the guidance actually walks through several examples of most of them, actually, with the exception of the international accords. Impact of climate change legislation and regulation is to be nominally distinguished from the indirect consequences of the same. So 1 and 3 have a lot of similarities. The strains there do. The direct impact, of course, are there sort of directly flowing out of any climate change legislation or regulation? Are there actual costs that the industry or the entity is facing? The guidance being written in 2010 actually focuses on the Kyoto Protocol, overlooking the Paris Climate Accord, but of course that would be something that companies should be paying attention to. And as I alluded to earlier, watching what the U.S.'s nationally determined contribution is this coming week could really well give an indicator of where we're going on climate, and thus bring additional rigor to disclosures here. As I mentioned, indirect consequences are perhaps the cost of goods or the costs of doing business associated with the climate change legislation or regulation. And then last, of course, and perhaps the one that's most obvious for operating companies, is just the physical impacts of climate change, whether it be direct impacts to the entity or interruptions in supply chain. But in addition to this 2010 guidance, on Friday, the SEC issued a risk alert following its investigation or look into the investment advisors and funds with respect to incorporating environmental, social, and governance factors. And the risk alert makes quite clear that the agency is going to heighten its focus in this area, and that investment advisors really need to make sure that their disclosures are actually aligning with ongoing investment practices, that within the financial entity there is sufficient and knowledgeable oversight and review by compliance personnel so that there is not a divergence between stated goals and actual practices, and then critically suggests substantial documentation of the process, the investment decision process. Turning to the next slide, and a little bit of sort of akin to what Ezra was just discussing on sort of where we envision the UK going, I anticipate increasing regulation from the SEC. These days, if you miss a day in the news, you are definitely behind the curve in the US with respect to what is expected or what is going to be expected of investors with respect to climate and ESG across a host of agencies, but most particularly pertinent the SEC. We have a sort of early February, they created a climate and ESG task force in the Division of Enforcement. There's also a senior policy advisor for climate, environmental, social governance. And, what will be interesting, I don't need to sort of read through this slide, but what will be interesting to watch is how prescriptive these regulations are. And I think many of the challenges that Ezra has been talking about, whether it's, across the EU and the UK, will apply here. It's how to quantify or prescribe reporting requirements across all industries. We'll talk a little bit about what's available in enforcement in a little bit. But I think just keep your eyes on the SEC, the CFTC, because there will be places for comment and engagement by the public. But I think it's certain that we will be working towards a substantially increased regulation. Next slide.
Thanks, Stacey. And I think, to your point there, it would be great to hear in a moment from Ezra about some of, I suppose, the lessons learned and the implementation risks or, guidance from coming out of the UK and Europe. Just whilst before we do so, I think I can answer this question anyway. But Ezra, could you just confirm that from the asset manager perspective, at least at the product level, these disclosures that you've been discussing are actually apply regardless of the underlying product. So this doesn't just apply if you're marketing something which is sort of supposedly ESG branded, but would be in relation to sort of any disclosure for any part of an EU client. Is that correct?
Sure. Yes, that is correct. And so the way that the SFDR works is that there are some basic disclosure requirements. So you have to disclose how you manage sustainability risk, and you have to you have to explain whether you take into account the principal adverse impact of your investment decisions on sustainability factors, i.e., you have to sort of confirm whether you're going to report on the ESG performance of your underlying investments. Or not. And if you're not going to do that, you have to explain why not. And those requirements just apply across the board. And then there are additional disclosure requirements for products that are either light green or dark green, i.e., so light green products are basically these products that promote in some way environmental social characteristics. And dark green products are products that have a sort of sustainability as an objective sort of baked in the product. And there are additional disclosure requirements then for those types of products. But there's a baseline disclosure required for anything.
Yeah, understood. Thanks.
And one thing I should just note on like the earlier question on the sort of whether there's a defined level, say of pre-industrial climate levels. And so I think that the right answer is that contractually, so I think that in the Paris Agreement, there are references to how that can be assessed. But there isn't it's not that everybody's agreed that it was, 34 degrees, so I think that there's sort of a larger reference period. And then actually defining how that works, and what would be the baseline against which you then measure the 2% increase in the global temperatures is then, it's something that you have to, I think, agree on the level that you're looking to legislate. And so in the EU, hence the engagement of the technical experts is largely the engagement of the sort of the climate change scientific community, and they will effectively come to a conclusion as to what it is typically with reference to like a larger time period, and estimating the temperature, at those time periods. So it's not, so I think just to be clear that as contractually, there's sort of a defined term around what the pre-industrial levels are, but as whether that's a objective scientific reality where you can come to a single figure and there's no disagreement about that, I don't think that is the case.
No, understood, and that's a helpful clarification. Thank you. I think we should turn on to the risk now. For people waiting for the CLE code, it is Global 415. So that's Global 415. I'll repeat that at the end. But it would be great, Ezra, just to take us back then to talk about some of those talking points and and lessons learned. I'm conscious of timing, so I know we have a number of slides. We probably need to move through them relatively quickly.
Sure. So lessons learned. I think that probably a sort of, at the outset, so there, it became fairly clear that, that on the market, there are managers and financial institutions who have been sort of running with ESG and are very familiar with it for a number of years, and who have, quite sophisticated processes and sort of proprietary techniques and arrangements. And for those, I think the sort of the SFDR implementation process was pretty straightforward. For those who weren't so familiar with it, I think that ESG was kind of a familiar buzzword, and at a high level, it was very, most of the market was pretty familiar with it, and it had been used in sort of investor communications for a while. But actually, to sit down and articulate in a meaningful way what the institutional approach to sustainability risk actually was, and to be able to then articulate that across different asset classes and geographies and techniques was, I think that was kind of harder than perhaps expected. And one of the things that became clear was that, a sort of starting point is really to understand actually what is the institution trying to achieve in terms of ESG. You can't do everything, and sort of an ability to prioritize and have a sort of clarity of ideas of what the ESG focus actually is for the institution, what's manageable, and what can you document, and what can you say where your practice is actually consistent with your internal processes was a sort of a key element. And another thing that I think watched this space was really probably a theme carried out from the concerns that both EU and US regulators clearly have around greenwashing, was understanding what is actually a light green fund. So there's some regulatory guidance outstanding on this, but I think that was really something that where many of our clients and many in the industry more broadly were, having to think about what are they doing? What is the fund actually doing, and how is it being sold? And so, it's a tricky question, given that it's so attractive to use the ESG dimension to market, because it's such an important focus area for investors at the moment. And then measure that against what the business thinks it's manageable, what is also the drivers of different investors, so, talking to UK pension schemes and talking to other, for US research schemes, for example, you may have a different set of drivers. Even if the institutional willingness is there, you may have a different set of, sort of legislative restraints or other kind of operational restraints or priorities. And so you have to try and balance investor needs, sometimes within the same single product or the same strategy. And so what you're able to actually tell the world about what you're doing is tricky. And again, that sort of consistency between what's externally advertised and what's internally done is critical. And on others, like most of these, actually, I think that we can skip. I had included some of them. Can we have the next slide, please? Very quickly, just the principal adverse sustainability impacts statement. So, that just has loads of different core. So that's this idea that, you kind of disclose your ESG performance in your portfolio, or at an institutional level. So you disclose your greenhouse gas emissions, carbon footprint, water emissions, sort of adverse effect on biodiversity, that all sorts of information that, is all required to be based on data, and data that, many institutions, many corporates don't create, and therefore many institutions just do not have access to. So I think that the sort of the prevalence and the sort of focus on a need for good quality data was like another sort of key realization in the process. But otherwise, I think that, this is for a fun reading for our audience, if they want to take a look at the sort of the detailed level of disclosure really expected for the ESG reporting. But I mean, I'm happy to. I think those are probably the key lessons learned from our perspective.
Thanks, Ezra. And for everyone online and listening, the slides will be available afterwards. So I think we could move to slide 39 now, I think. So there's a lot of detail on those slides, which you can obviously take away. Just to repeat my dreadful English accent, the CLE code is global 415. So that's GLOBAL 415. And then with that, I think if we just move forward, Stacey, could you perhaps just, perhaps wrap us up with a bit about, broader implications and risk from your perspective and how you see that?
Absolutely. And I invite Ezra to jump in as well. As we were really discussing about risks associated here, it was quite clear that there was a lot of alignment on the risks, no matter where you are. And so principally liability arises in two contexts. The first is, of course, consumer protection or consumer fraud claims under, federal laws, state laws in the U.S. And across the broad swath of regulatory frameworks in the UK and EU. And then, of course, enforcement provisions under the various security laws. Ezra touched on a few times the concept of greenwashing, and this is an area that I think is a place, particularly in the U.S., that regulators, enforcers, and also citizens groups will be keenly focusing. And in fact, I shouldn't be using the past tense. They have been focusing on it already, looking very carefully at statements that are made and whether intentionally or unintentionally creating misleading suggestion that the fund or that the company is doing far more than is made than is actually doing in practice. Before I skip to the next slide, Ezra, being mindful of time, anything you'd like to add?
Oh, I think that similar considerations. I think that one of the sort of risks, I guess, with increased disclosure is that, number one, there's a concern, should you have been disclosing that information already, misrepresentation or mis-selling claims, especially on sort of historic products. I think that there's the greater transparency, I think, also adds to greater anxiety as the information being put out there gets more and more expansive.
A great point, Ezra, and that's particularly the case in the U.S. I think companies are really grappling with the fact that this guidance I spoke about is a 2010 guidance, and if they haven't been disclosing, why are they making that decision this year? If we turn quickly to the next slide, this is really sort of contemplating moving forward how you manage your risk in the context of all these additional disclosures you'll be making, and of course, using forward, these are all very, I'm sure, common and well known to each of you, but using aspirational language or forward-looking statements, bring the same amount of rigor to your ESG statements for accuracy that you have been all along for financial statements. We get asked that question with some frequency, and it's, as I understand it, is a common concern of how much rigor we have to bring to that, and really, as we move forward, it's the same amount of rigor. Ensure consistency across statements. Make sure that there is a person or a group, an entity that is in charge of ensuring that there is accuracy and responsibility for hewing towards policies. Ezra, anything last word?
No, I think that's very much, very much. I agree with that.
All right, thank you then, everybody, and to the panelists. I think, it's really clear as we look through it, just the breadth of the implications as we see there and the general levels of risk. I'm sure we could fill another webinar thinking through some of those risk liability management points, whether there's sort of litigation risk, whether we have anything to look to going forwards. I hope we've managed to answer everybody's questions as we've come through. Thank you to the audience for listening. The team at Akin are very focused on ESG, and we have a podcast series coming out in the next coming weeks and months. And also we have a live sustainability blog as well. So any questions, just reach out to the panelists or your Akin contacts. And thank you very much again for listening.
Thank you. Listeners, you've been listening to Akin Gump Partners and ESG Group co-heads Amy Kennedy and Stacey Mitchell and financial regulatory partner Ezra Zahabi. Thank you, listeners, as always, for your time and attention. Please make sure to subscribe to On Air with Akin Gump at your favorite podcast provider to ensure you do not miss an episode, special or otherwise. We're on, among others, iTunes, SoundCloud, and Spotify. To learn more about Akin Gump and the firm's work in and thinking on ESG matters, look for ESG at the Experience and Insights and News tabs at akingump.com. Take a moment to read Amy, Stacey, and Ezra's bios on the site, and then visit our Speaking Sustainability blog, which features our lawyers' thinking and analysis on all matters ESG related, and follow our Speaking Sustainability Twitter. Until next time. On Air with Akin Gump is presented by Akin Gump and cannot be copied or rebroadcast without consent. The information provided is intended for a general audience and is not legal advice or a substitute for the advice of competent counsel. Prior results do not guarantee a similar outcome. The content reflects the personal views and opinions of the participants. No attorney-client relationship is being created by this podcast, and all rights are reserved.